Vanguard is one of the largest retirement account providers out there, and they just released data on 5 million of their 401k and 403b customers from 2022. So how good of a position are these investors in for retirement? Or how bad is it? Let me show you some interesting trends that I uncovered in this 115-page document when it comes to how much money they have invested, how much of their income is actually being invested, what they're investing their money into, and a few more eye-opening things. Overall account balances is a great place to start. In 2022, the stock and bond markets were down, so we see a decline in average account balances when we compare it to the previous year. That's a drop of about 20 to 23%. As a reminder, the reason we see such a big difference between average and median balances is because the small number of accounts with very large balances skews the average amount way above the median. Remember that the median balance represents the typical account holder, so half of all participants had balances above the median and half had balances below. One other thing that I want to call out is that even though account balances took a big hit in 2022, when we compare it to 2021, if all of those investors would have stopped contributing as the market was falling, then the numbers would look much worse. But since most of these investors were continuing to contribute to their 401ks while the market was falling, the damage wasn't as bad because of the contribution effect. One of the worst times that you can either stop contributing or reduce your contribution amount is when the market is falling. So always fight that natural urge to run for the hills. Psychologically, it's really difficult to continue investing at those points in time, since there's usually other things going on in the world that make you question whether or not you should continue investing. Think of events like high inflation, the health scare of 2020, the 08 financial crisis, and 9/11. But this is where a lot of your future returns are going to come from, since you're able to buy in at lower prices. It's why I always say that the world could be burning down, and I will continue investing into my 2-fund portfolio no matter what. Before I show you the balance breakdown by age group and income, here's the percentage breakdown of account balances by different ranges. Only 26% of accounts have more than $100,000 in them, which is close to the average balance that we saw in the previous screenshot. While it's fun to look at the overall average and median balances, it can be a little misleading. That's because it doesn't really make sense to compare someone who is saving for retirement in their 50s versus someone in their 20s. Same thing with a person who is earning $150,000 per year versus someone who is earning $35,000 per year. Obviously, the person who is older or has a higher income should have a higher balance, since they've been working a whole heck of a lot longer. I know, we always see those young people online who are making hundreds of thousands or millions of dollars per year. But let's be honest, those are like the super outlier top less than 1% of people. If you're someone who is trying to compare yourself to them, then you need to get off the internet, go outside, touch some grass, and talk to normal people. Here's the balance breakdown by income level. As you would expect, people with higher incomes have higher balances. There's something going on with those people who have a high average balance with an income of less than $15,000, because their average is more than the next group up. I'm guessing there are some retired people out there who are working a side hustle just for fun. What's up? It's me post-filming. I just wanted to put something else in here that I thought about at this point in time. Besides working for fun, some of these retirees, since the market was down in 2022, might have decided to pick up some side work so that way they could withdraw just a little bit less money from their portfolios at that point in time. This is something that a lot of us pre-retirees don't really think about, or we forget about. Once we retire, if the market is down and we don't want to withdraw money from our portfolio because it's down, there's a lot of levers that we can pull. One of those levers, for example, is getting a side job where we make just a little bit of money so we can withdraw just a little bit less from our portfolio at that point in time until it recovers. Another thing we can do is adjust our spending while the market is down, and then once it recovers, we can go ahead and increase our withdrawal rates back to where it was in the past. I'll show you how much participants are contributing to their accounts in just a minute, but financial experts suggest contributing between 10 to 15% of your income every single year. I'm a bit of an overachiever because my mom and dad didn't really love me as a child, so I personally like to see people at least 20%. So those with a $100,000 income would aim for investing $20,000 per year across all of their retirement accounts. As always, being able to actually do this is going to depend on what's going on in your personal life, since it's different for all of us. When we look at this breakdown by age group, the broke people, people under the age of 25, aren't even in the double-digit range yet. In all seriousness, people under 25 are pretty new to their careers, so it's a little tough to say whether this number is good or bad. Moving from that age group to the next one up, we see an over 5x jump in the average and median. This type of thing isn't out of the norm, because generally, we see that the contribution amounts increase as we get older. Before I show you how much these investors are saving, please help support my little dog Molly, as well as this channel by hitting that thumbs up button and sharing the video. Vanguard participants saved 7.4% of their income on average in their employer's plan in 2022. This is usually referred to as the deferral rate, but since I've had a bit of a speech impediment since I was 8 years old, when it comes to saying certain words with the letter R, I'm going to call this the savings rate going forward. Your savings rate is such an important number to know because it doesn't matter how much you make if it's all going right back out the door as fast as it's coming in. When we look at the savings rate by income, there is a couple observations that I want to point out. Compared to the previous year, 401k savings rates didn't change for the people earning less than $50,000 per year. Since 2019, which was right before the world flipped upside down, it looks like the same group of people either stayed the same or increased contributions relative to income. For the group of people earning $50,000 or more, their savings rates dropped compared to the previous year. But since 2019, all of them have had a net gain except for the people earning $150,000 or more. For all of you losers who like to hate on people who make a lot of money, this should make you happy. We're naturally going to see ups and downs from year to year with these rates, but when we zoom out to look at them over a longer period of time, we get to see how things have changed for each income group. As a whole, all income groups have increased the amount that they're investing versus their income by 0.4%. When we dig deeper into these numbers, from 2013 to 2022, the bottom three income categories are saving less today than they were back then. The people in the $50,000 to under $75,000 group haven't changed, and the investors earning more than $75,000 have all increased the amount that they're contributing to their 401ks and 403bs. I have some promising numbers to show you with savings rates when it's broken down by age group. For people under the age of 65, over the past 10 years, we've seen them all increase how much they're investing into Vanguard 401ks relative to their income. The most significant jumps have come from people under the age of 45, which in my opinion is extremely encouraging. Look at that. People under the age of 35 have increased how much they're investing by almost 1%. I know 1% doesn't seem like a lot, but when you take into account how younger people usually don't have as much money, in my opinion, once again, this is huge and headed in the right direction. These numbers don't include the amount an employer matched either. When we account for employee and employer contributions, the average and median rates increase. In 2022, 69% of participants contributed at or above their employer match. After contributing for 3 years, this number grew to 76%. Before I show you how these Vanguard participants invest their money, one thing to remember is that we need to take this account balance and savings rate data with a little bit of a grain of salt for 3 different reasons. First, it doesn't show us the full picture of how much everyone in these income and age groups are saving, since it's only for their Vanguard sponsored 401ks and 403bs. If any of these people have non-Vanguard 401ks, 403bs, HSAs, taxable investment accounts, or IRAs, then that is not counted. Realistically, it would make sense to look at these numbers as the bare minimum amounts saved for retirement by these individuals, which is a good thing. The second reason that you should take this savings rate data with a grain of salt is because participants with lower wages are going to have Social Security, I can never say that word, replacing a higher percentage of their income in retirement. Social Security. I have to say it slowly so I can say it properly. On the other hand, people with higher wages are going to have Social Security replacing a lower percentage of their income in retirement. The third reason is because the amount each of us need for retirement is going to be dependent on how much we plan to spend. For example, there's a 99.9% chance that I'll never retire in a high cost of living crazy state like California, so naturally, I don't need to save as much as a man or woman living there. Another example, you may be someone who continues to live a very healthy lifestyle so that you end up spending less on healthcare compared to a very unhealthy, overweight person who is a financial drain on their retirement savings and society in general. And someone else might be going into retirement with a paid off home, so they won't need to pull as much every single month from their retirement accounts. Because of these factors, it doesn't make sense to look at overall 401k balances and assume that these groups of men and women aren't saving enough. If you want to know how to figure out the amount that you need to save for retirement, then I will link my video on that topic and down in the description and at the end of this video as well. How investors allocate their money is always an interesting one to check out. Over the past 10 years, the amount invested into equities has stayed fairly stable across the board. Check out that massive increase in the use of target date funds. Vanguard notes that a lot of this has to do with the fact that more and more companies have started to auto-enroll employees into 401k plans unless they actively opt out. When auto-enroll is chosen by an employer, the default investment he or she is put into is a target date fund. For any of you not familiar with the whole psychological idea behind this, forcing someone to have to go out of their way to opt out of contributing to a 401k is what's called a nudge. A nudge can be used in a way that ends up being a net positive or a net negative for a person on the receiving end. The idea behind this is that most people are lazy. They're more likely to do nothing than do something. Just like the 40-year-old guy that I know who still lives with his mom and has never driven a car because he refuses to get his license. He'd rather do nothing than something. I think we can all agree that getting more Americans to invest for their future in a 401k is a good thing. So if you make the good behavior, aka investing in a 401k, the default option, then most people wouldn't go out of their way to opt out of that action. While I've been fairly critical of target date funds in the past because I think they invest too much into bonds for younger investors, I am very happy with this being the default option. More people need to be investing for their future so that they are less reliant on daddy government leading up to and in retirement. I've mentioned in the past how I think that everyone should be trying to switch jobs on a regular basis to increase their income so that they can invest more for retirement. But Vanguard found that the longer an employee's tenure with the company, the more likely they are to earn a higher salary, participate in the retirement plan, and contribute at higher levels. They mentioned how longer tenured participants also have higher balances because they've been contributing to their employer's plan for longer periods of time. Based on my personal experience and talking to a lot of other people, you make way bigger pay jumps when you switch employers. The most common number that I heard was around 20%. Making more money and continuing to invest at a higher rate to build a higher balance are two totally different things though. The longer you stay with your current employer, the easier it's going to be to slowly bump up the amount that you are investing in your 401k as time goes on because there's less friction in the process. But when you swap jobs for a higher income, you have to go out of your way to choose to carry over that same contribution percentage when you enroll in that new 401k. In theory, it's easy to do, but very difficult behaviorally. So for all of my people out there swapping jobs for more money, please, 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 for gosh sakes, make sure you keep your contribution amount the same or increase it as early in the process as possible. Another positive trend over the past 10 years is that investors have less allocated to company stock. The general idea for why it might not make sense to invest in your employer's stock while you work there has to do with trying to avoid having your income, emotions, and investments closely tied to the same source. If there happens to be a financial issue with the company that forces them to downsize, then not only will your portfolio potentially take a hit, but losing your income is a possibility if you happen to be one of those people on the chopping block. Plus, I'd be surprised if most people even do the proper due diligence before buying their employer's stock at full price or a discount. To your left are those videos and playlists I promised you earlier in the video. More personal finance and investing help is down in the description below. Please make sure to hit that thumbs up button and share the video to help support the free content on this channel.